Good morning, everyone. Thanks so much for joining us this morning for this session on auto-enrolment. We're absolutely delighted that I can't even speak properly, Bruce Stanley from HLB Ireland has agreed to help us with this. We've had tons of questions come in, which we're really delighted about. And so I'm just really delighted to hand over to Bruce.
Thanks, Irma, and good morning, everyone. Delighted to be here and talking through this auto-enrollment retirement savings system. So today we're going to have a look at the My Future Fund, which is the pot and the portal that will be used for the auto-enrollment. We'll be talking about the eligibility of individuals who will qualify for auto-enrollment, the contribution rates and how they're going to increase over time, and then also a little bit more about the mechanics of the scheme and what employers and employees need to know in relation to it. So let me just move this on. Um, so the eligibility is the first thing. So anybody who is who earns over €20,000 a year and between the ages of 23 and 60 and is not already in a pension scheme that's being operated through the payroll would be automatically enrolled. So this includes everybody, whether they're on probation, if they're casual, seasonal, part-time contracts, even if they're only working kind of a gig where it's a 1 day, but it's considered to be a payroll, they're automatically enrolled. There is a voluntary opt-out for employees. There's voluntary opt-in for employees who are outside of the age group or income thresholds. So anybody who's over 18 and under 66 can opt in if they're not between 23 and 60. And also if they're earning less than 20,000 a year, they can opt in for this. So those people that are currently excluded from it are the people who are self-employed, if they're not earning, or if they're existing members of an occupational pension scheme or a PRSA that's operating through a salary. And we'll look at an example here of somebody who has two different employments, one which has a pension contribution, one which doesn't, and how that works. So a lot of people in the industry will obviously have multiple employments and be working from different jobs. So the way that this will work for the 20,000 threshold, they have to look at their gross pay from both of them and add them up together. So under this example, we have the job A, which is only earning 10,000, and job B is earning 15,000. So the total is over 25,000. So in this case, the auto enrollment applies to both of these. So they pay the employer on job A pays the 1.5% over, deducts the 1.5 from the employee, and the state contributes the 0.5%. And the same happens in job B. So these are amalgamated so that the employee who's working over numerous different jobs is not disadvantaged compared to an employee who only has one single job. Then this is a different example where we have, in this case, job B has an existing pension contribution. So this employee is a member of the occupational pension scheme for job B, but not for job A. So when we're looking at the €20,000 threshold, we still combine both jobs, but because job B has an occupational pension scheme, they don't have to apply the auto enrolment. Job A applies the auto enrolment in respect of the 10,000 that's being paid there, but job B doesn't because it's already contributing either through a PRSA or an occupational pension scheme. And again, that second job is taken into account when you're looking at the €25,000 earnings. So the next point here, I suppose, is the contribution rates. This is going to be where the kind of additional costs for the employers is going to come from. So at the first year, it's going to be kind of a small enough rate, which at 1.5, but it's going to gradually increase up to 6%. So when kind of contracts are being negotiated with employees, it's going to be important to take into consideration that these additional payments are going to be due. And what's typically happened internationally is that when contract negotiations are happening, that these are considered then as part of that remuneration, so that it's for new contracts, it's considered. Obviously, if you have existing employees and they're as they stay on, their costs are going to go up by these amounts. So the goal eventually, as I say, after 10 years, it would get it up to a total of 14% as a contribution from all the parties. sorry, the other thing to say just here as well is there is a cap on this, and the cap is at 80,000 euro. So if anybody is earning over 80,000 euro, it's the 1.5% is capped on the 80,000. Okay. So next, we're just going to talk about some options for the employees. So an employee here has the option to opt out of the auto enrollment. So everybody is going to be automatically enrolled who qualifies for this from January for the first 6 months. Then in July or August of next year, that will be the first opportunity that they have to opt out of the auto enrollment. If they do opt out, they get a refund of their employee contributions. So the 1.5% that they've contributed will be returned to them. But the employer contributions of the 1.5% and the state contribution of 0.5% will stay in their investment pot, that My Future fund, for them. That does not get refunded to the employer. And if they do opt out, then from that point on, the employer no longer has to make a contribution and the state no longer makes the contribution either. The other option that they can make during any time is, rather than opting out, they can suspend their contributions. So if they suspend their contributions, they don't get a refund of the payment that they've made, but there's no further contributions going during the period of suspension. There is then the automatic re-enrollment. So after 2 years of being opted out, the revenue will automatically re-enroll you, or if you're suspended, they'll re-enroll again. And you need to then either suspend it or opt out again if you want to keep that suspension or opt out in place. The times when you can opt out are that 7th and 8th month after the initially being put into the system, or the same period after each increase in the band rates. So once the rate increases from 1.5% to 3%, after 6 months, you again have the option to opt out and then get a refund of those contributions. So that's the part. The other key features here are that the pot will follow the members. So it is an individual kind of pension pot that's in this My Future fund. And all of the contributions that are made, if you're in different employments, it doesn't go into a different pot. It all goes into the one pot. Your employer pays into that one investment fund for yourself. The investment fund, there's 3 different investment fund managers that were selected by tender that are managing the investments for the individuals. And there are 4 different kind of investment strategies. So there's the default strategy, which will start off on a higher risk option until I think you reach the age of 51. Then it goes into a medium risk, and then at 61 it goes into a lower risk. So if the person doesn't make any decision in relation to their investment options, it will automatically follow that default. You can, however, go in and decide to change your investment risk option and set it at high, medium, or low. So that's an individual choice for the employee. The way that is done, there's going to be a portal that people can log into called My Future Fund. And this is where the employer will log in and also the employee will log in. So the employee can log in and change the way that their investment is managed. This is also where they can suspend or where they can opt out. All of this is going to be managed by a national body called NERSA, which is the National Auto-Enrolment Retirement Savings Authority. So they are going to do all of the administration around that. So an employee opts out, it's NERSA that will then inform the employer that they no longer have to apply the deductions. On all of the kind of investment decisions, investment strategies, again, that's left to be managed by NERSA and the individual employee. The employer has no input into that whatsoever. Then I suppose at the retirement or drawdown, this is whenever you can reach age 66. So what happens to it? You can't draw down any earlier than 66 from this fund. When you do draw it down, it's a bit like a normal pension. You can get 25% of the fund tax-free, but then the balance is subject to income tax in the person's hands. It's not in place yet, but the legislation has ways to suggest that the money could be put into an ARF or to purchase an annuity the way that you can do with kind of a regular pension. There is a possibility for early drawdown on if there's ill health and you have to retire, but there's a burden of proof to prove that. Again, you'd be taking it as a lump sum and it would be taxed in the same way. And then if on somebody's death, if somebody dies before the age of 66, the fund is paid to their estate and it's subject to income tax rules. And the estate pays it as an income tax salary, and then it forms part of the estate and passes with the rest of their assets. So that's kind of the exit of it. So NERSA are the organization that are going to be the administrators for this auto-enrollment system. So this is kind of the role that they have to play in this, and they will be doing the majority of the administration. So whether or not an employee is eligible for the auto-enrollment is going to be a function for NERSA to decide. It's not for the individual employer. NERSA will inform the employer via the payroll information that you download from the revenue system when you're running your payroll through the payroll software. They will let you know if you need to apply the auto-enrollment for those individual people. So it's not up to the employer to figure out whether or not they get a total of 20,000 from all of their jobs or anything like that. It's NERSA that will do that. The opt-in and the opt-out and the suspension, that's all going to be managed via the portal. Again, NERSA will be managing that. If an employee goes in, an individual goes in and decides to opt out, NERSA will then update that on the information that's sent from the payroll, from revenue to the payroll provider software, and it will be managed through that way. It's not a case of the employee telling the employer that they want to opt out. They will also manage the re-enrollment after the 2 years. If somebody has opted out, the automatic re-enrollment, that's not something the employer has to look after. NERSA will look after that. And they will also manage what is an exempt employment or if it isn't an exempt employment. And the investment decisions, that's all managed again through NERSA. They're the ones who will be dealing with the investment providers. And if the individual chooses to change their investment portfolio risk, for example, and wants to go with a lower risk or a higher risk option, that's going to be managed by NERSA. There's no management of the pension required by the employees. The payment at retirement, that's going to again come through this organization. It's not a payment that needs to be processed through the employer's payroll. And you don't have to track kind of previous employees or anything like that. It's all just managed through this one pot. NERSA will also be responsible for monitoring compliance. So there's some obligations that all employers have to comply with under the legislation, and NERSA are the ones who will be the watchdogs for that and make sure that those obligations are being met, and there is potential penalties for non-compliance. They will also kind of manage all of the website and the employer and the employee portals. So when the employer kind of logs in, they're both logging into the same website, but they'll just have different interfaces depending on whether they're an employer or an employee and the options that they will have. So this graphic here is just to kind of show a bit kind of how the mechanics of the investment of it works. So your employer, and you can have multiple employers here, would be paying in, the employee would be paying in their portion, and then the state pays in their portion. So at the moment, the state contribution is 1/3 of the employee and 1/3 of the employer contribution. The employee contribution as well, it's important to note that there's, unlike with a pension contribution, there's no tax deduction from that. So if somebody is earning, let's say, €50,000 a year, the employee contribution would be €750. That will come out of their net pay. They don't get a tax deduction for that contribution. That's a net pay deduction. The tax contribution in this, or the tax advantage in this, is effectively mirrored by the state making the pension contribution of the 1/3 of the employee contribution. So this money all gets paid into this pot that's managed through this portal, My Future Fund. Then the investments are in there. There's there's 4 different investment options where you just have the default, or you can change to a high, medium, or low risk. And then the goal is that pension pot will grow. So the pension pot should be there tax-free. It'll grow tax-free until the employee reaches the age of 66. And then at 66, on employment, or on retirement, there will be the option to take the cash out, which will be 25% tax free, and the rest of it will be taxable. There should also be the options to put it into an ARF or into an annuity that again will be monitored and done by NERSA. It's not an employer obligation. So just a little bit more of the mechanics of how it's envisaged that it will actually work. So the first thing that NERSA does is it identifies any eligible employees. So it does that obviously on an individual basis. Whenever that employee is then registered as an employee of a particular company, the employer downloads the information from Revenue when they're running the payroll, and an auto-enrolment payment notification, or AEPN, is issued via that payroll. The employer then the employer gets the latest AEPN then from the Revenue, and then the contributions are applied and a contribution file is returned. So at that stage, the employer withholds the 1.5% net pay from the employee, and they top it up with their 1.5%, and then they need to make that payment to the My Future Fund portal. And it's important that that payment actually has to be made by 6:30 p.m. on the day that the employee is paid. So if you're doing a weekly payroll and you're paying your employees weekly, then you will need to do these payments weekly to the My Future Fund portal. It has to be paid the same day the employee is paid. It's not like the PAYE where you just pay at the end of the month. So if you're running a monthly and a weekly payroll, you could have 5 or 6 of these payments to process each month. Then finally, once the contributions are collected, say they're put into this pot for the individuals, and then they're invested with one of the 3 providers that have been chosen for the state. So the role of the employers or the payroll operators here. So really what as employers you need to do is you download the latest AEPN, which is part of the kind of the regular payroll that you would be doing. You apply that and you create a contribution file. So it's envisaged that all of the payroll software, this will be a function of that payroll software, and it will sort of happen automatically. It'll tell you what you need to pay. You then need to pay over the employee and the employer contributions, which doesn't get paid to Revenue, it gets paid through the My Future Fund. And then if there is an employee who is being enrolled for the first time, then you need to let them know that they're being enrolled and give them the information on it, and let them know how to manage it and where to go. The department said that they will be providing information for employers that they will be able to provide to employees, which will be able to assist them in letting them know their obligations or their entitlements. So there's kind of 3 key steps for employers to be aware of at the moment. So the portal isn't actually available yet, but meant to be on the way. When the portal is ready, it'll be called My Future Fund. The employers need to log into this and to complete the employer profile in December. It's important that you have this done in advance of January, because there's an obligation straight away for some employees that will be enrolled in this portal that the payments are going to be managed. So all employers should go into this portal in December and make sure that your details are there. This is through this portal that you set up the payment method. You can set it up as a direct debit. So anybody who's using the Revenue online system at the moment, Ross, for paying the PAYE obligations, it's a similar system that can be set up there. You can set up a direct debit, and that can be set up in advance in December, ready to go in January. Then when January comes along, we run the payroll as normal. We get the contribution file. The payroll PAYE payment goes to Revenue on the following month, but the contribution for the pension goes to the My Future Fund on the same day as the employee is actually paid. So say if that's a weekly payment, then there's a weekly obligation to make that payment to the My Future Fund. So some compliance here. Employers have to ensure that they're acting in accordance with the legislation, and there is compliance framework there to process non-compliant employers. There's going to be fines and penalties in the case of non-compliance. The compliance should be reasonably straightforward, as long as you're registered on the portal before January, and as long as if you're using kind of software in order to run your payroll, it should generally provide you with the information fairly clearly. It is a fixed rate of the 1.5%, so it's not that it's going to vary between employee, and it's not up to the employer to determine which employees it applies to. They will be told by NERSA who it will apply to. It'll be a case of just downloading it, getting the information. The non-compliance really only would be if you weren't actually paying the fund over. So if an employee is opted into or is auto-enrolled and you weren't making these payments, that's where there's the potential risk of fines and penalties. But the administration of it shouldn't be too difficult. This is just something that's kind of come up a bit where we've been asked about whether is somebody better off being auto-enrolled or actually looking at a PRSA or making their own kind of pension contributions. So where we just wanted to do an example of this. So from the PRSA point of view, if you're earning more than €44,000, you're going to get a 40% tax relief. The state contribution is more equivalent to a 25% tax relief, because if you put 1.5 in and the state puts 0.5, 2 has gone in, but the state's only contributed 25% of that. So you can get more tax relief from the PRSA. From the fund choices, you only really have 3 investment strategies, and there's only the My Future Fund that you can go into under auto-enrollment. So you're a bit limited on your options from the choice point of view. The reality, I think, is when people do PRSAs, they just go with kind of the advice of their financial advisor anyway. So people don't actively manage their PRSAs all that much. So possibly with a high, medium or low risk, that's kind of okay for a lot of people anyway. Pension access is an important one, in that if you have a PRSA, it's possible to access your pension from the age of 50 years and onwards. So if you want to look at an early retirement, the pension access is much better under a PRSA. You can't access your auto-enrollment fund until you're 66, except for in cases of ill health. So the access options are much better under the PRSA. The employer contribution, there's full flexibility on an employer contribution. There's no guarantee that an employer has to make a contribution from this. So from this point of view, auto-enrollment could be better in that there is an obligation on the employer to make a contribution for an employee. So particularly if you have an employee who isn't at the 40% tax bracket and doesn't already have a pension, and pension funding might be difficult, this auto-enrollment is better because they only have to put 1.5 in, but there's kind of a 2% top up. So it's better from that point of view from the individual. But if you are part of an occupational pension scheme, or if you have an option to join an occupational pension scheme where the employer is making a contribution, then that's generally better, because the employer's contributions and schemes are generally more than the 1.5% if that's something they offer. With the PRSA, the financial reviews, normally the PRSA provider will provide the person with a statement, give them a review, and you can meet with your PRSA provider and discuss your appetite for risk and all of those things, and get a more bespoke product for yourself. With auto-enrollment, there is no financial reviews. You can log into the My Future Fund website and see how your fund is performing or what contributions have been made, but there isn't that individual access to a fund manager. The employee contributions, from the PRSA point of view, they're a lot more flexible. You can choose the level of the contribution that you want to make. So you might want to make more than 1.5%, for example, because you might need to put in more in order to generate a larger pension fund for when you retire. But with the auto-enrollment, there's no flexibility on this. The contributions are a set percentage, and you cannot kind of say they want to add more or reduce it if they want. There's just no flexibility on it whatsoever. And then on the PRSA, the death outcome, it's actually the PRSA is better that the fund is actually just paid into the estate tax-free. With the auto-enrolment, the fund is treated as a benefit in kind. It's taxed on income, and then it's the after-tax amount that goes into the estate. So generally speaking, if you want to build a larger pension pot, and if you're at the 40% tax rate, the PRSA would be the better option. But for people who are possibly at the earlier stages of their career or are below the 40% tax rate, then auto-enrolment is possibly the preferable option. So just a little bit of the planning for it. So just a couple of tips here. I suppose it's important that employers are aware that there is the additional cost. So currently it's only going to be 1.5%, but by year 10, that will be an additional 6% cost for employers. So to be aware and to figure out which employees that this may apply to, and to make sure that that's in your budgets for 2026. Completing your profile on the employer portal. So as soon as it's up and running in December, it's important to get in there early and put in the employer profile details and set up the payment methods so that you're ready to go when you're running your payrolls in January. If you should probably just review your current pension coverage to see who's already in the company pensions, and maybe it's a conversation with employees as well, whether if somebody's not in the company pension, whether they would like to do the company pension rather than the auto-enrolment if there's an opportunity for them to join. The updates in the payroll software, so the payroll provider, just to make sure that you have your latest updates and the software is up to date in order that you can run the auto-enrolment through the system. And then just the details of how you're going to inform the staff of the changes. So it would be important that this is communicated to staff if they're going, because it's going to be mandatory for everybody for the first 6 months. So if somebody hasn't had a pay increase, there's going to be that reduction in their net salary of the 1.5% for those that it's applicable to until at least June before they can opt out. As I say, they will get those contributions back, but they just need to be aware that that reduction is going to happen. So there was some just clarifications that were just been floating around, just the administrative burden. There's been a lot of talk that it would have this extra admin burden for employers. The reality is NERSA will actually handle most of the bulk of the administration. It's really just the additional payments that need to go into the My Future funds through the portal that will be the additional administrative burden. The business cost, this at the moment it's kind of being phased in over the 10 years, so it's only a kind of 1.5% business cost at the moment, but still a lot of people in arts organizations run to very tight budgets, so that is an additional cost. But I suppose it needs to be factored in the future when contract negotiations are happening, that this is an additional cost for the employer, just the same way employers' PRSI increasing is an additional cost. And it's a question of whether or not it replaces the state pension. It doesn't. The state pension is an addition to this. It's not a replacement. It is an additional pension saving to build up a fund for retirement. So if you're contributing to your state pension through your PRSI, that will remain in place. There's a question as well of whether the state could use the savings, because obviously when you pay your PRSI, that goes into the state coffers that is being used to provide various different services. It's not actually earmarked and set aside for a pension. This My Future Fund is earmarked. It's set aside into a particular investment pot that you can go in and see. And these are not kind of being used by the state currently. It's just an alternate way of pension funding. So that's just to clarify that. Next one here. Additional notes. So there's a look back period. So this relates to if you have part-time employees or employees who are moving between regular jobs to see whether or not they qualify for the €20,000. So what revenue or what NERSA will do is look back over the previous 13 weeks, so the previous quarter of the year, and if the individual has earned more than €5,000 in that 13 weeks, then NERSA will assume that that person qualifies for the €20,000 threshold, and that they will then be auto-enrolled. So it's not a look back over the previous year. It's just that 13 weeks. The second point is just about making corrections. If there is an error made on an amount that's been paid to the My Future Fund by the employer, you don't go back and amend the previous period the way you would do with the PAYE system. You'll just adjust it in the next payroll period. So if you've underpaid or overpaid in January, you can just make the correct adjustment then in February. Then the last part of this is just that the tax agents have access to payroll through Ross will also be able to view the My Future Fund system for the individual companies that they work for. So if you do have an outsourced payroll function, your tax agents will also be able to view that information and assist you with any queries that you have there. So points to note, the first thing I suppose, again, just to stress this again, is that it's really important that the employer profile is completed on the portal. That's done in December, just so that you're up and running. The income from multiple employments is considered for the auto-enrolment, so people with multiple jobs, it's all combined, but it's again NIRSA that will look after that. It's not the role of the individual employer. There's currently no minimum standard for existing pensions, in that if you are a member of an occupational pension scheme, if you were only contributing 1% instead of 1.5%, that doesn't make a difference. If you're an occupational pension scheme, you're in an occupational pension scheme, so it's not a qualifying employment for auto-enrolment. So that employment wouldn't be subject to auto-enrolment. And there's no waiting periods for auto-enrolment. So if you get an employee and it's their first week, if they're subject to auto-enrolment, they will be included in auto-enrolment from that very first week. It's not like with an occupational pension scheme, sometimes you have to be with the company 6 months before you'll be joining it, but that's not the case with auto-enrolment. So before, I've sent some questions here just before, and I think I've answered kind of a lot of these in the presentation, but I just wanted to answer them individually as well, just in case there was any clarity needed. So the first thing about the general understanding, so what routes are available for the employee and the implications. So the employee is automatically enrolled if for any employment where they don't have an occupational pension or a PRSA being operated through the payroll. They can opt out, but they can only opt out after 6 months. And if they do opt out, they get a refund of their contributions, but the employer contribution and the state contribution remain in the pot for them. Those aren't refunded. They can also suspend at any time. Suspension means that they don't get a refund of contributions, but they don't have to make any more contributions, and the employer and the state don't contribute on their behalf. And then they're automatically enrolled in after 2 years again. And then I suppose there's those investment options, and that can be done through the portal. The individuals will access that through their MyGov ID and in My Future Fund, and that's where they can make their investment decisions. So the next one, can employers who don't already make a contribution to an employee pension put their auto-enrolment amount into a regular pension scheme instead of into an auto-enrolment if the employee chooses to do this? So if an employer wanted to set up an occupational pension scheme on behalf of an employee, then you could go that route. Once a pension is running through an employment, that employment shouldn't be qualifying employment for the purpose of auto-enrolment. So if you are doing that option, then yes, you wouldn't have to be auto-enrolled if your employee puts in the employee contribution. So if an employee already has an employer PRSA that employer is not contributing to, so if the PRSA is running through the payroll, in that there's a net pay deduction operating through the payroll, then that employment doesn't qualify for the auto-enrolment. If it's a separate PRSA that the employee has set up individually, separate from their employer, that is, they're making a tax claim for in their income tax return, then that employment would be subject to auto-enrolment, and they would get the 1.5% deductions unless they opt out. If your employer does not currently make any contribution to an existing PRSA, does auto-enrolment not effectively punish those who have been prudent by already saving? I suppose if you wanted to, if you ceased to make a PRSA payment on a net pay agreement with your employer, if you're already doing a PRSA, then that employment would then qualify for auto enrollment. So you could do that option if you wanted. I think the reality, most people who are making PRSAs want to do larger contributions in any event rather than the 1.5% if they've already set up a pension. But I don't think that you're necessarily being punished, because I think there is the opportunity to cease the PRSA and go the auto enrollment route if you wanted to. So that's my take on that. What is the situation with people who already have private pensions? Are they auto enrolled as well? So they are auto enrolled in relation to any employment where the pension isn't being managed through that employment. So if you're not on a net pay agreement with a PRSA, or you're not in an occupational pension scheme and it's just a completely separate pension, then that employment would be subject to the auto enrollment. So in the earlier example we had, where there was two employments and one of them had a pension scheme and one didn't, the one that didn't, because there wasn't a pension scheme running through that payroll, the auto enrollment does apply to that employment. Just how to navigate part-time, short-term contracts and who is eligible. So that's all NERSA are going to be telling you that as soon as you register somebody as an employee, whether or not they're eligible is just advised to the employer by the revenue when you download the payroll information from them. And so it's not something that you need to consider for part-term and short-term contracts. Yeah, they will apply for those. Subject to the individual being a qualifying person. So the limitation about earning 20,000 a year, is this for a specific employment or an annual total for the employee? It's the annual total for the employee. How can the employer know this information while processing the payroll for seasonal employments? So again, this isn't something the employer has to monitor. NERSA will monitor it and inform the employer if auto enrollment applies. Again, we have a number of temporary part-time workers. Is there a certain number of hours they have to work to get registered? No, there's no waiting list on this at all. If there waiting time on this at all, as soon as they are on the payroll, they can be subject to auto enrollment. Do we pick the pension provider we pay the contribution to? No, you don't. It goes to the My Future Fund that it gets paid into. There are 3 different providers then that have been chosen by the state to provide the pension products, and the employee can decide the investment strategy for themselves. So that's all kind of separately managed. The only obligation on the employer is just to pay into the My Future Fund. The rest of it's managed by NERSA and the employee. Will employees get statements each year to say what has been contributed by them? They won't, I don't believe. They will be able to, however, log into their own personal profile in the My Future Fund through the MyGov system. And on there, they will be able to see what their contributions are, what contributions have been made, and what their pot is at the moment. So how does it affect self-employed workers? Are we expected to enroll ourselves? So unfortunately, you can't be part of the auto enrollment if you're self-employed, but you can set up your own pension fund. So you should go to speak to a financial advisor or to a pension provider, and they will help you with that. So then the last questions that were there were on the retirement payouts. How does a pension get paid out at retirement? So at the moment, it's 25% gets paid out tax-free as a lump sum, and the balance gets paid as subject to income tax. The alternative is it gets put into an annuity, to purchase an annuity for life, or else it goes into an ARF. Do you have to choose a pension provider to facilitate this, or does the government provide it? So the government provides the pension provider in order to create the fund, then you have the options on your retirement, what you do with that fund. So that would be where you would choose your own provider. It's not clear yet whether the government will facilitate that with or will provide access to a pension provider or whether you kind of go get your own. On retirement, is there any stipulation of payments of pension to employees? So no, the pension payment on retirement is managed by the My Future Fund. It's not an employer obligation. So that's the last question I had. So I'll stop sharing there. And if anybody has
Thank
any
you,
questions,
Bruce. That was absolutely amazing. There's a such a dense amount of information. There was a few questions that came up in the chat, and I think that you've answered some of them, but I might run through them really quickly. Um, would a part-time employee qualify for auto-enrollment if they earn, say, 15,000 from the theatre, I guess their employer, but the remainder of their income is self-employed?
no, I don't think they would because they look at the employment income of the 20,000.
Okay. Um, and then there was a question on the investments, like what are the risks that we could lose our contributions? Is there any insurance protection available?
No, there isn't. So it's like any investment, it can go up or down. You can choose your level of risk. So if you're at a very low risk level, then you're kind of going to be invested more in bonds and cash, but there's very little uplift on it. So you're at the mercy of inflation. But if you're high risk, then it, it can fluctuate quite significantly. This I would advise people if they are looking at it that they would want to review their risk if they're in the default system, because the default will change you from high risk to medium risk and then from medium to low. And it might not be a good time to change your risk strategy if there's been a sudden dip in the markets, for example. You want to be able to suffer the rebound because most markets will eventually kind of recover from where they were. So if you automatically go to a lower risk, you might miss out on the rebound.
There's another one there. Will it be possible at a later date for an employee to transfer funds in My Future Fund to their own PRSA?
I don't believe so. No, I think once it's in My Future Fund, it's there till you're 66, so you can't access it.
Um, I think we've answered this one. Can a person have a personal pension and also be included in auto enrollment?
They can, as long as the personal pension is being run through the employment that they're auto-enrolled.
Um, do we have to do the profiles online even if all employees have a PRSA? So I suppose
Um,
situation no, right?
I wouldn't have thought so because I don't think there's an obligation. But if you were, yeah, there wouldn't. If there's no obligation to make the payment, I wouldn't have thought that you would need to register.
There's one here. Can a company switch to a private pension fund after auto enrollment starts? So I suppose that's a company that might decide to bring in their own PRSA or their own scheme afterwards.
I think so. I don't think the revenue would be restricting that because I don't think it would make sense to restrict that option. I think once you are running a payroll through the employment, then it ceases to qualify for an eligible employment for auto enrollment.
And this one's kind of connected then. So say if a staff member sets up a PRSA after being auto enrolled, will they still have to wait until the opt out window or is there a process to swap? So I guess it's similar.
Yeah, my understanding is that it would cease to be an eligible employment once you're doing the PRSA, so that would you would no longer be making the contributions then.
So then the employee would get back their payment, but the employer stuff would stay. Isn't that right?
Well, no, I think that's not opting out. What's happening is you're changing from not an eligible employment to a non-eligible
Gotcha.
employment. To get your contributions back, I believe you have to opt out,
Okay.
which there's only those windows where you can opt out.
Gotcha. Um, if an employee lives overseas, but they work here on occasion, do they have to be registered?
I believe so. If
Yeah.
yeah, that's my understanding of it. Yes, it applies. There's no.
I guess
Sorry,
the
it would
payroll.
depend though, because you would be looking back at the 13 weeks to see whether or not they made the €5,000 in the 13 weeks to see whether or not they're auto enrolled. But
Okay.
again, this would be something that NERSA will tell the employer, so the employer doesn't have to worry about figuring that out. And you don't have to know whether the overseas employee has done work here so far in Ireland, you know.
And then there was just a question, can there be agent access to My Future Fund portal similar to Ross, where the agent can make the payments weekly in sync with the payroll processing?
Yes, I believe so. The tax agent should have access to it.
Sorry, apparently I missed two questions. Do you have to have a MyGov ID? Is one of them?
For an individual, in order to log in to the portal, I believe you do.
And then will all employers be informed when the portal goes live? I presume so through.
I presume so. I'm not sure what channels they'll use to do that, but yeah.
I guess it's worth
Uh,
saying it's probably worth logging in to Ross to check that, because sometimes, yeah, you could potentially miss it, I suppose.
yeah, like it will be a different portal, so I'm not sure it's a different login through a My Future Fund portal rather than the Ross portal. So I'm not entirely sure of the mechanics yet, and until the portal's up, it's hard to know. Yeah.
And last question, and then I'm going to stop the recording. And if anyone wants to ask anything, they can just unmute after that. But is there anything we can do about ethical investments or any choices there?
No.
Yeah, that's what I was thinking. And the 13-week look back is for casual workers. Would that be a fair reflection of a year, I guess, when people are potentially having periods of not working, etc.?
So my understanding is that it's kind of under a constant review. So if you haven't qualified in the last 13 weeks, but 5 weeks later, if you looked back over the previous 13 weeks, you would qualify, then you get auto enrolled.
Okay. Okay. I'm going to just stop the recording. Thank you so much.